People running away from the fiat money products now into real tangibles. So when you're referring to the spot gold market, that's a contract market. And even whether it goes up or down today is really more about traders than it is about reality, because in the physical world, yeah, premiums are going up pretty substantially. Availability is declining pretty substantially. So we are seeing, that shift that's occurring as people really fly to true safety. And there's been an outflow from stocks, bonds, money funds, etc. Globally, central banks have added more gold in the third quarter. So we haven't even hit the fourth quarter yet. And yet this is the highest level of gold buying that's just taking place through the third quarter ever. Who really knows how close we are to the end of this fiat money's life cycle than central banks? And part of the problem and part of the big risk is that what they're really trying to do right now is claw back their credibility, which they gave away to the markets, last August, when they kept vowing a 50 basis point move and then did the 75, and then the markets go, oh wow, well, we can't trust this forward guidance, which has been a huge tool since 2008, 2009. So that puts us in a really dangerous position. And, as you said earlier, they're going to keep hiking until something breaks. And I think what's happening in the UK is the canary in the coal mine, because this is really a crisis of credibility. And in any con game, you've got to have your victims have confidence in you. Well, the premiums were trading at the lowest level that we've ever seen historically. And so that has begun to shift. And even as we're watching spot, which is just a contract, decline, we are watching the premiums on the collectible coins expand again, as well as on just your base metals, whether it's gold or silver. So, but here's the thing. The physical market is actually based upon supply and demand. So those traders are not in there moving the prices. We're watching huge increases in bar and coin demand for individual investors. The only area that we're really seeing a decline in is in technology because of lower demand, as well as in ETFs and that kind of thing, which are just paper products anyway. China's looking like their premium on just regular gold is at all-time highs. So, and China's been accumulating, huge accumulator of gold. I mean, we really don't know how much gold they have. I would also say that I've been studying currency life cycles since 1987. So while my expertise is in this area, it's because this is sound money, gold and silver, physical in your possession, that runs no counterparty risk and is the only financial asset that has this level of history, 6,000 years, 5,000 years of history of fighting inflation, holding its purchasing power value. And when I think we're going to see it expressed towards somewhere near its fundamental value, will be when they do those overnight resets. So when the public has lost all confidence in the system that's currently in place, and we're close, we are so close. That's why inflation is so important. It's not even the inflation, it's the expectations, right? That's why that's so critical, because I believe that when the public has lost confidence in the system, that's when we're going to get the hyperinflation. And history, because there's no purchasing power left, and history shows that in order to regain that confidence in the public, whatever that new money is will have a component of gold in there to generate that confidence and stabilize that value, not at 100%. I think that it's somewhere before June 30th of 2023, because that's when that transition from LIBOR to the new benchmark, it'll be different depending upon where you are in the world. That's when they are finally going to have to do it. And I've had a lot of people say, and I mean, look, this is not within my control. Well, what if they just postpone it again, like they did back in 2020 or 2019 when they ran the test? Well, but as of January of 2022, all new contracts have to be issued against that new benchmark.
Yeah.
So I think we're at the end of this can kicking. I really do. And I think, you know, I've been saying it since the beginning of the year that 2022 is a pivotal year because of that transition. I don't believe they can do it. Wall Street actually doesn't believe that they can do it. That's why it was so hard to get them to adopt any other benchmark, and they continue to use LIBOR primarily until January of 2022, where they had no choice. Nobody really knows. But when we talk about the pivot and lowering rates and you know, printing lots of money, you know, you have to understand that they have a very limited tool set. So until they can really create the CBDC and have a big enough crisis to just give everybody a bunch of CBDCs so that people can, at least for a minute, buy their food and keep shelter over their heads, you know, a pivot. You know, I think there will be a big pivot. They will never admit that it's their fault because they never admit that it's their fault, even though it is all their fault.
Yeah.
At this point, there isn't one doubt, having studied currencies and currency life cycles since 1987, there is absolutely and has been zero doubt in my mind that we are at the end of this currency's life cycle.
Yeah.
So when you talk about equities, when I convert equities, what do I convert them into? I convert them into dollars. This is a $10 trillion Zimbabwe.
Yeah.
What can you buy with it?
Nothing.
Nothing. Right? You can't even buy 3 eggs with it.
No.
So I don't participate in the equity market or the bond market or any of those fiat markets. I'm an ex-stockbroker. I mean, I have a high level of comfort with all of that crap, and I see how really convoluted and manipulated it all is. So in the future, I expect to participate, but I want to see a bottoming. I want to see a